We're joined now by Keith Wade, Chief Economist at Schroders. Keith, let me start off with kind of the information that the Fed has in front of it. The weather seems to have, and a lot of data are seasonally adjusted, the weather seems to have confused things.
I think it has. It's been very mild over there, and that's actually provided a boost to the housing market. And the key thing that the Fed has to decide is whether or not the economy now is beginning to gather pace.
Yep.
If you look at some of that housing data, you say, yes, it really looks like it's on the up now. But what we have seen recently is some signs that the housing data is beginning to roll over a bit. And I think the key judgment the Fed needs to make at this stage is, how is the labour market performing, and will it continue to strengthen? We saw one slightly weak payroll number about a month ago, and Bernanke is on record as saying that he has some doubts about the sustainability of the recovery in the labour market. And I think that's the key thing, because we've seen unemployment come down, even though the economy hasn't been growing that fast, and Bernanke thinks that's a bit of a puzzle, and that we could well see unemployment going up again later in the year.
At this stage, though, wait and see?
I think it is a wait and see. And of course, the inflation numbers have been quite well behaved. So there's no great pressure on the Fed to start reacting and trying to do something, you know, to head off any inflationary pressure. Inflation expectations are well under control. Wages are under control as well. So he's got a little bit of leeway. I think the other thing in the back of his mind, will, of course, will be the experience of last year, when it looked like the economy was doing pretty well at this time, and then suddenly it rolled over. And I think that's a characteristic of the kind of economy that we're in, that's trying to emerge from a very deep financial crisis.
The US recession doesn't feel self-sustaining right now. If we do see the data roll over, if it starts to get a little bit worse, do you think the doves will gain traction? Like, Yellen's been out sort of making her point very clearly. The doves are kind of backed off a little bit, but you can easily see just a few series starting to roll over, some of the high-frequency stuff coming through a little bit more negatively. Yeah. Do you think that will be enough to trigger a sort of much bigger push from there?
I think it probably will be. I think the unemployment rate will be the key thing. Normally in the US, you'd need to see the economy growing at about 3% or more than that to bring unemployment down. And so if the economy is rolling over now, and it's only been growing at about 2.5%, I think they'll start getting concerned about unemployment. The other thing that they've got to think about this year, though, of course, is the presidential election.
I was about to bring that in, November.
So, yeah, and I mean, that does affect their timing on QE. I think they'll probably think, well, if we're going to do it, we probably want to do it by the end of June. They may not want to be right on the radar screen during the presidential election doing QE. So I think there will be some really intensive debate about that.
What form would it take if it were to happen?
What they would do, I think they would actually start buying bonds, probably mortgage-backed securities, and they would concentrate their firepower on that part of the market. Most probably, yeah.
But that's the likely form it would take. Do you think it would be similar in size to the previous examples?
Probably, yes. I think they would be looking then to sort of try and drive those yields down a bit more, and they'd probably have to announce something similar in size to do that. They would probably also, I think, be focusing again more at the longer end of the curve if they do some more buying in the Treasury market. Operation Twist has been quite successful in bringing down those longer rates, and I think they've been quite pleased about that, because that does feed through into the mortgage-backed securities market.
You've already alluded to the fact that they are probably watching very carefully the unemployment series. What about asset prices? It seems that the trump card that the bulls in the equity market can play is, you know what, if this goes south, the Fed's going to step in, and we're going to get things going again. How much attention is being paid, do you think, to what is happening on the equity markets and other asset classes as well?
Well, I mean, quite a lot. I mean, those asset prices are key in terms of the way that they can impact onto the economy and help the consumer side. But the most important asset price, I think, from a macro perspective, is still the house prices and that part of the market. And that, I think, is one of the reasons why people still have some doubts about whether or not the economy is really on a recovery track. Because consumers are seeing their equity being gradually eroded, and a lot of consumers are in negative equity. And we know that when they're in that position, people tend to save more because they want to pay down their debt, and of course that slows the economy down. So, yeah, the equity market obviously a critical indicator, but I think house prices are also right up there on the screen for the Fed.
And we've got the Europe to think about and all the other things that they're certainly thinking about. Keith, we must leave it there. Thank you very much indeed for taking the time to come and see us. Keith Wade joining us from Schroders.